Hi, welcome to the second video in my finance series that I hope will help you to become more successful in your business. As a business owner myself for many years, I understand the challenges that you face. Today, I'll be diving into financial statements in all their numerical glory. I'm not planning to give you a training course in bookkeeping or accounting methods or go into too much detail about these topics. There are plenty of good software packages out there and plenty of specific training courses available. So if you need more training, please take advantage of one of those. As a business owner, you don't need to do the books yourself or even understand the finer details, but it's vital that you understand the basics. So that's what I'll be covering today. More importantly, you need not just to understand the basics of financial statements, but to take time to review them and then take action upon that information. This last step, taking action, is both the most important and the most neglected by small business owners. Imagine that you've just paid to go to a major sporting event, say a game of football, and you walk inside the stadium and there's no scoreboard. You can't find the scores online either. No one is even keeping score. The teams are just playing for the regulation time and then walking off. How boring would that be for the spectators? And how demotivating for the players? Financial statements are the scoreboard of business. The scores are measured not by runs or goals or points, but by dollars. Without accurate, timely financial statements, you can't tell if you're winning or losing. And that in business is vitally important information. In sport, if you lose, you can just lick your wounds, cop a spray from the coach, and front up for the next game. But the discipline of business is bankruptcy. There are no safety nets or consolation finals. Just as sports competitions have stages and strategies, there are three critical stages relating to financial statements. Stage one is collecting the data and using it to create your financial statements. You may have heard of the expression, garbage in, garbage out. The data that goes into your financial statements needs to be as accurate as possible. Unless your business is at the very small startup stage or you genuinely love doing the books and are good at doing them, then I'd strongly recommend you staff or contracting out your bookkeeping. Stage two is reading the data. You can delegate 100% of the financial statements preparation, but you must learn to read them yourself. To properly read and comprehend anything, you first need to learn how to read. I'm going to run through the briefest of summaries in a moment, but for everything else beyond this, please get help. It's not enough just to know how to read and understand financial statements. You must read and review them regularly. I would suggest for most businesses, monthly is ideal, certainly quarterly at least. I know that many small business owners only take a cursory look at their financials once a year after the accountant prepares them for their annual tax returns. Often this is 6 months or more, even further than that, after the end of the financial year. It's like driving a car with your eyes closed, apart from glancing occasionally at the rear view mirror, say once every block. You won't even know what hit you when you crash, because you won't have seen it coming. Now we'll run through some key things you need to understand about using financial statements. There are two main components of any set of financial statements: the profit and loss statement and the balance sheet. Your profit and loss is often called the P&L for short. It shows you how you've gone for a particular period of time. Often this is for a financial year, which in Australia runs from the 1st of July till the 30th of June next year. But in different countries, it's different, such as in the USA or New Zealand. It's a good idea to have your bookkeeper add extra columns to your P&L. I like to see 4 columns. current period, be it a financial year, quarter, month, or whatever period you're looking at. And then the second column is comparison to the same period for the previous year. Then 2 columns of percentages, one for the current period and one for the previous period. P&Ls start with sales revenue at the top, which is sometimes called turnover. Then they deduct the cost of sales, sometimes called cost of goods sold, or COGS for short. This gives you your gross profit. Then they deduct expenses, sometimes called overheads. This gives you your net profit, which is literally the bottom line, which is why the widely used expression is, what's the bottom line? Some people have trouble understanding the difference between cost of goods sold and expenses, and where to allocate various payments their business has made. A simple way to think of it is this. Your expenses are relatively fixed. Whether you don't sell anything today or not, you still have to pay for your rent, your electricity, your insurance, and so on. So they're all expenses. But your cost of goods directly relate to the amount of stock you need to buy and other direct costs of sales, which should be closely linked to your sales. And that's why they're also called variables. Moving on to the balance sheet, unlike the P&L, which is for a certain period of time, the balance sheet is for a certain date. In Australia, this typically means the last day of the financial year. So the balance sheet as at 30th of June, for example. The balance sheet also has a standard format. At the top, your assets are listed. Assets are usually broken up into current assets, such as cash, and non-current, such as fixed assets, property, and the like. Next are your liabilities. Finally, your liabilities are deducted from your assets to give the bottom line, which in this case is called equity, or in some cases, it's called owner's equity. Your owner's equity can sometimes be a negative number. Owner's equity plus liability should equal your assets. In other words, they balance, which is why it's called a balance sheet. Your balance sheet actually links to your P&L. Here's how. Suppose your balance sheet, as at the 30th of June 2019, shows equity of $100. Then for the financial year of 2019-20, you show a net profit of $10. Then your balance sheet as at 30th of June 2020 should now show equity of $110, being the original $100 plus the $10 profit from the year of trading. If you made a $10 loss, then your equity would have gone down to $90. Of course, this is a very simplified example, but it illustrates the link. Finally, stage 3 is making decisions and taking action upon what your financial statements are telling you. This is using your financials as a business management tool. That's what smart, successful businesses do. So why don't you join them? Here's a tip for free that consultants will charge you a fortune to do. It's one of the quickest and easiest ways to grow your net profit. Suppose you're running at a 5% net profit. If you can save $1 from any expense, it will go straight to the bottom line. In other words, every dollar you save in expenses will be $1 more on your net profit figure. But to get the same impact on your net profit by increasing sales, you'd have to sell $20 more, because $20 times 5% net profit rate equals $1. So take a good look at your expenses. Put a ring around the biggest ones, say the top 5 or 10, depending on the size of your business and the length of your expenses list. If you have the percentage column switched on, like I mentioned earlier in your financial software, it will be easier to pick out the big ones. Then consider each one of these one by one. How long have you been with the same supplier or on the same deal for that expense? How long since you've put each one out to tender? In other words, sought at least 3 competitive prices for that product or service. If your answer is never or not for years, then take action now. This is classic quadrant 2 work. It's not urgent, But it's important. If you don't know what I'm referring to when I say quadrant 2, then please go back to video 6 from my first series about the 4 quadrants. It's worth repeating. Every dollar you save from expenses goes straight to your bottom line. Going back to our business example that's making a 5% profit, if they can save $10,000, that's the same bottom line effect as selling an extra $200,000 worth of products with a lot less time, effort and headaches to go with it. This is just one example of how you can use your financial statements as a tool to take positive action and improve your business. I could give you many more, but for now, we've run out of time. In my next video in this series, I'm going to help you see the difference between turnover and profit and why the second of these two is so much more important to your business. If you'd like to get my future videos as soon as they're posted, then please subscribe to my series. If you've benefited from this video, then please write a review and like this video on the screen below. And please contact me if you'd like a free personal business coaching session. I believe that with passion, consistent effort and wise advice, you can succeed in your business. I wish you all the best, and I'll see you next time.